Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. I use this name in a little bit different context. I prepare a number of videos throughout the week. I do a daily video and a condensed version of the daily video update every day. I also do a weekly video and an intermarket analysis video. At the end of the week, I go through the daily charts and I pick out those charts that I didn't use very much, if at all, in the past week. This video takes those charts, puts them all together in this video to see if we can get some insight or clues as to what's happening in the market. This is being prepared for Monday, August 14th. The first chart is of the VIX, even though you don't see it on this chart. This is a 50-period exponential moving average of the VIX. Typically, we will use static numbers with the VIX, from about 12 to 12.5 up to 20, but the VIX is also very dynamic, and so this allows us to see those dynamic ranges. From 2008 through 2011, we had a range of about 40 to the upside to 20 to the downside. Then we dropped down, and we're in a lower range for a while. Then after the whole COVID plunge, we went back up and we're in a higher range. And we're wondering right now, over on the right-hand side, are we starting to drop to an even lower range? It'll take some time for that to work out, but we just want to keep an eye on this. Another VIX study that I did end up showing this past week is the VIX to the VIX of the VIX, or the VVIX. This takes a ratio between the two. And right at the end of 2022, we saw this top out and begin to come down. That is typically positive for the market when this is declining. Right now, we're watching this because it's starting to turn back up as the market's been running into some difficulties. We'll keep an eye on this to see if we see a change in trend. The next chart is the VIX, and then we take a 3-month average of the VIX and then do a ratio. I mostly pay attention to the red line. We've been declining overall, but as the market's been having some difficulties, we're starting to see this red line turning back up, another thing that we'll keep an eye on. When the VIX is really acting strange, we look at it a little different way. We take a VIX to the S&P 500 correlation, and that measures what's in the middle. And when we spike up here, that usually means the market's going to do something. And then we came back down. Well, a number of days have passed since we saw this spike, and the market continues to decline. That's usually what ends up happening. If you want to see what happened other times before, when this correlation spiked up and came down, you can see these red lines down below. Usually, this meant some kind of a top before we started to decline, but it doesn't always mean that. Sometimes we need other charts to show us what context we're looking at. Then we look at the skew index, and I did show this a time or two in the past week. We came up into this red area. This is another indicator based around the VIX, where the VIX measures things with at the money options. The skew index measures out of the money options, so we get a little bit different reading. When we get up into this red area, that means the market is expecting something. When we top up and start coming back down like we did, sometimes that means a continuation of what's been happening. Other times that might mean a top. Other times that might mean a bottom. Again, we have to use other charts to get some context. Just as a point of reference, down below, I also have another chart of the VIX. We also watch the VIX to see how it's moving, and we plot an RSI 9 period on here. We did get extreme positive, meaning the VIX was going up really quick. That also means stocks were going down, but now we've fallen back down to more of a neutral reading. Then we look at the MOVE index on top, which measures bond volatility. Then we drop below that and we come down to the VIX, which measures stock volatility. Then looking down below, the red line is the S&P 500. And then the green line is the VIX minus the MOVE index, which shows us the spread between the two. I don't pay as much of attention to that. What I follow is right at the bottom. I want to see the correlation between the MOVE index and the VIX. And right now it's showing that their relationship is not very strong and getting back down to being more neutral. Then we look at a ratio of the VIX to the MOVE index, where it had spiked up a little bit. We're above the moving average and it's starting to turn back up, suggesting that overall market volatility is picking up. We look at the equity put call ratio. I would love to show this chart in my daily videos, but it's the last chart to update, and a lot of times when I'm ready to record, this chart hasn't updated yet. We can see on a daily basis that we're really starting to go up, meaning that people are buying more puts than calls, and that's more of a defensive strategy when the market is running into some problems. So typically this will go up as the market is going down. The other studies that we do on this are based on 5-period moving averages of the equity put call ratio. We also want to keep an eye on where are we from the all-time high. We're coming down a little bit now. We're down 7.35% since the early part of January 2022. Some technical alerts. These are put out by stockcharts.com. You don't have to be a member to access these. They're generated automatically, and they look at indexes and sectors and other areas in the market that we want to pay attention to. When they're red like they are here, that means they're negative. If they were to be positive, they would be blue. We read this from the bottom up. On Friday, right after the market opened, the Nasdaq dropped below the 13.7 level. Later on in the day, the tech sector had a BPI cross below 50. That's when we're going from positive over to negative. Another thing that we look at are 5 basic indexes. We look at the Dow, the S&P, because that's what we really focus on, the QQQs, which is the Nasdaq 100, the mid caps, and the small caps. Stock Charts also has a non-emotional way of ranking these technical charts on a score of 0 to 100. The higher the score, the better looking the chart. Coming in first place, which has been first place for quite a while, are the QQQs, which is the Nasdaq 100, coming in with a score of 97.3. In second place is the S&P 500, represented by the spiders, and that's coming in at 86.9. In third place is the diamonds, representing the Dow. This comes in at 82.4. In fourth place are the mid caps, coming in at 58.1. And in last place is the IWM, which is the Russell 2000 small cap index. It's dropping below 50 with a score of 49.4. We have some short-term charts to go through. This chart shows a 20-period double and triple exponential moving average study. We dropped below this and we're starting to come back down. This was our first line of defense. When these are coming back down, that means in the short term we're turning more negative. We also keep an eye on a regular 20-period simple and exponential moving average. We're also dropping below this, and both the lines are starting to roll over. We look at a short-term rainbow, which I actually was able to show a couple of times this week. We're dropping down inside the rainbow. We're going to be watching these lines to see if they begin to roll over. When we're seeing this nice smooth upward movement, that means that we're in a good solid trend. It may be in danger now, so we'll have to see how these lines end up reacting. I also have an indicator called the boom indicator. That's how far away does price get above or below a moving average. When we get far away, the moving average tends to act like a magnet or a rubber band and brings price back to it, whether it's above or below. I have a 20 period, a 50 period, and a 200 period study on this chart. The reason this is in the short-term category is because I mainly follow the 20 period moving average. Then I get some longer-term insight as I look through this chart. We're not getting an extreme positive or negative reading right now, although all these moving averages are declining, so that's overall negative. Looking at the fundamentals, we have the S&P on top. We have earnings, which are flat because they're coming out, but they haven't really been updated yet. When the S&P has been coming down and the earnings are staying flat, we had been going up with the PE ratio, but since we're declining with price, the PE ratio is rolling over a little bit, and it might be hard to see, but the yield at the very bottom, it's turning up a little bit as the S&P has been coming down. Some intermediate term charts. This is the Connors RSI. It's kind of a short-term RSI in that we use it for extreme positive or negative readings. We also follow the dashed line. When we're above the dashed line and advancing, that's positive. Below the dashed line and declining, that's negative. Right now, we have more of a negative stance with this indicator. We also look at the Bollinger Bands. We're falling below the midpoint and we're coming down to the lower end, but we're not getting an extreme reading yet. That's measured by the %B indicator. When we go outside of the upper or lower Bollinger Band, this will give us an extreme positive or negative reading. And although we are declining, we're not getting an extreme reading right now. Then we have an intermediate term rainbow chart going from 50 periods up to 100 periods. We're coming down to the top part of this rainbow right now. The S&P is really testing its 50 period moving average. We'll have to see if we bounce up off of that or if we're going to fall down into the rainbow. We also look at standard deviation. This is what is the standard or average price over the last 10 periods, and we're coming right up to about equilibrium right now. We also look at the Copic curve. It was generating a buy signal, but then we've crossed below the red line, so that signal is no longer being generated. The mass index, even though it's advancing, we don't pay attention to this until we go above the red dashed line or the blue line, so it's not generating a signal right now. We also keep an eye on the CMB composite index. This is supposed to be a standalone trading system. I use this like an oscillator to get extreme positive or negative readings. We did have an extreme negative reading recently, but then we've been bouncing back up. If we see more follow through downside action, we might get another extreme negative reading. We also look at a 50-period double and triple exponential moving average. We're dropping below both the red line and the blue line, and these are also starting to roll over. That could put the intermediate term trend in danger. Then we look at the Sean trend meter. It had been extreme positive for a while, and now it's dropping back down more into neutral territory. The Pring bottom fisher was generating a buy signal recently, but now we've crossed back below the red line, so that signal is now gone. We look at an anchored moving average going back to the all-time high. Even though the S&P has been declining, we're still far above this level. We also keep an eye on whether we're above or below the 200-day simple moving average. When we're green, we're above it, even though we have been declining since the last part of July going into the first part of August. This is a chart that I refer to in every video, but I haven't been showing it because where we're at right now is far away from this red line. What I did on this chart is I have a trend line going from the June 2022 low down to the October 2022 low. Then I drew a parallel line going from the all-time high down, and when we were going up, this acted as resistance, and it looked like it might hold there for a while. We bumped into this point a couple of times, and it looked like it was providing resistance, but then we were able to break through this, and we've been above it ever since. Even though the S&P has been declining, we're still far away from this line. We also keep an eye on the Ichimoku cloud. When we're above it and declining, this may provide support in the green area. When we're below it and advancing, that might provide some kind of resistance. Even though we've been declining, we're still above the cloud as of right now. We also keep an eye on the S&P 100, which is on the bottom, and compare it with the S&P 500, which is on top. We were seeing a divergence here where the S&P 500 was outperforming the S&P 500 earlier in the spring, but now they've been moving more in lockstep with each other. We have a long-term rainbow chart going from 50 periods up to 250 periods. We are coming down to the 50-period moving average. We're wondering if that will provide support. So far, these lines are still flowing in an upward direction, suggesting the long-term trend is still positive. Then we look at a moving average study. I keep a 50-period moving average up here on top. What I'm really looking at are the 150 and 200. We had been extreme positive with both of these, but now we're starting to come back down. One of the charts that I've been showing every day is a shorter version of this chart. If we go all the way back to the 1987 crash and we put price on a log scale and we connect some bottoms here, this is providing a trend line going all the way up to where we're at right now. We had the dot-com bust low. That's where we draw the initial low. And then when we broke down in 2008 and dropped below this level, that's when things were signaling that they were a lot more negative. And then we spent a long time trying to come back up. We hit it again in 2018 and bounced back down. We hit it again in 2020, right before the COVID plunge. Then in 2021, we were able to break through it. We came down below it, and now we're starting to come back up to this. We're wondering, is this going to provide overhead resistance for the S&P? We also look at a weekly chart of the S&P and compare it with the German DAX weekly chart. Sometimes these indexes move in the same general direction. We're seeing that relationship starting to really weaken as they go in opposite directions. Then we look at the US 10-year yield, and then we subtract the German 10-year yield, and that gives us a line. And then if you compare that to the US dollar index, you'll notice that sometimes these lines have a tendency to have a strong correlation. However, that's not what we're seeing right now. The correlation is dropping off between the two. Some support and resistance levels. First, we have a quadrant line where I went from the COVID low to the all-time high, and that breaks these up into 4 different chunks, with each one being 25%. This did come into play earlier in 2023, but we were able to break through this. And we're still far away from these levels right now, so I haven't been showing this chart. Our short-term fib chart, we had more than 100% retracement, and we're breaking out above that. So we haven't been using this chart. This will only come into play if we continue to fall, and this may provide some kind of support. Our longer-term fib chart, kind of the same thing. We broke through the 61.8% retracement level. Even though we're falling back, we're still well above this level as of right now. Then our long-term fib chart, pretty much the same thing. We're breaking above multiple fib levels. Even though we're showing some weakness, we still have a long ways to go to get back down to these other retracement levels. The NASDAQ 100, the same thing. We broke above the 61.8% retracement. We're up here in no man's land, and we continue to be in no man's land even with the declines that we're seeing. Some broad market measures. This is the Vixen, where the VIX measures the S&P 500. The Vixen looks at the NASDAQ 100. I don't use the upper chart all that much because there's a lot of crazy data on here. I mostly look at the line chart on the bottom where fear is starting to pick up, but it has been dropping off. We keep an eye on the micro caps. We really watch this when we drop below 100. We recently set a new 52-week low. Since then, we've been able to bounce back up, and we're actually seeing a golden cross with this index. We also keep an eye on the weekly chart of the QQQs with an anchored moving average going back to the all-time high. Even with the declines that we're seeing, we're well above this line. The financial sector. Way back in 2007, we set a high, and then it took us a long time to get back up to this same level. We fell back down during the COVID plunge. We were able to break through this in 2021. What had been resistance now becomes support, and so far, even though the financial sector's been under a lot of pressure, we've been able to hold support above this line, and right now we're kind of far away from it, so I haven't been showing this chart. Some rate of change charts just to keep an eye on things. These are long term. This goes back 250 periods where we are seeing this chart decline, but we're still above zero. This is a longer term look going back to 1980 of the same chart, also showing some recent weakness. Keeping an eye on bonds. We have the S&P 500 on top. That's the red line. And then we have the long-term bond ETF, which is the blue line. We look at the long-term correlation between the two. For quite a while, they tended to have a pretty strong correlated relationship. We're seeing that fall off now as they go in opposite directions. We take a shorter term look at their relationship where they're going in the same basic direction, but we want to see the longer term relationship turn back up. We also measure down here the spread between the two, and it's still quite wide even though it has been declining. Then we keep an eye on a bunch of different yield curves, the 10 to the 2 and the 10 to the 3 month. That's what the market really focuses on. We had something interesting happen this past week where the 30 to the 5 actually went back to being normal, or after Friday's session, it's now back to being inverted. We also compare 3 to 7 year bonds based on price with the S&P 500, and then we take a ratio of that. As this has been going down, that means that stocks are outperforming bonds. But lately, this has been bouncing back up, showing in the very short term that bonds are outperforming stocks. However, we're still in a downtrend with this ratio. Then we look at the value to growth ratio, not the growth to value ratio, but the value to growth ratio, and we compare that with the 10-year yield. They had been going in opposite directions. Now they're starting to go more in the same direction. Sometimes we can get some insight in this. Over this past week, we saw value outperforming growth, and people are wondering, is there a real shift going on in the market? If that's what's happening, then we might see this relationship get even stronger. We look at the Qs to the long-term bond ETF, where they're pretty much neutral right now. When we're at minus 0.25 to plus 0.25, that's neutral. When we break above 0.25, that means they're going in the same direction. When we break below minus 0.25, that means they're going in opposite directions, and the spread between the two is decreasing slightly. Then we look at the equal weight S&P 500 and compare it with an inverted version of the MOVE index. This relationship continues to be neutral, so I haven't been showing this chart. An update of some possible positive scenarios. We look at those stocks in the S&P that are above their 200-day moving average. It is declining, but we're still above 50. We also look at the stocks in the S&P that are above their 50-period moving average. Also declining, but still above 50. We look at the stocks above their 50-period moving average with the mid caps. Also declining, but still above 50. And then the small caps, also declining, but still above 50. This is another chart that we can use sometimes on a short to intermediate term basis. When the 2-year yield spikes up and comes back down, sometimes that gives good support for the S&P 500. Unfortunately, what we've been seeing a lot in 2023 is the S&P 500 and the 2-year yield have been going in the same direction. So this chart really hasn't been helping us that much. Thank you. I really hope you found this useful. I hope you check out some of the other videos that I post. Have a great day, and I will talk to you in the next video.